Hello, everybody. I hope you're having a really good day. Thank you so much for being channel members. I've been getting a lot of questions and a lot of inquiries from people asking me about options. So I want to give you a very basic explanation, but it's going to be pretty detailed, and you're probably going to know more than most people after this video. I know that sounds counterintuitive and that's an oxymoron, but I'm going to make it super simple for you guys to understand, and it's going to be more than most people know. There's two types of basic options. There's very complicated ones, but we're going to talk about what 99% of all people know about or heard about. There's a put and there's a call. You can buy a put, you can buy a call, you can sell a put, you can sell a call. If you are buying a put, you are spending money. If you are buying a call, you are spending money. If you are selling a put, you are collecting money. If you are selling a call, you are collecting money. If you are buying a put, this is a bearish stance on the market or your stock. If you are buying a call, this is a bullish stance on the market or your stock. If you are selling a put or selling a call, in my opinion, it's neither bullish or bearish. It's a completely different strategy, and my most favorite strategy that I'm making a lot of bank on. Shout out to Midwest, who's definitely watching this, and he's making a killing on selling options as well. So you have puts, you have calls, you have buying puts, you have buying calls, you have selling puts, you have selling calls. Let's explain what this exactly is. When you are buying a put, you are saying that you're going to sell your shares at a different date at a certain price. The benefit of this is you're saying that you're going to sell your shares at a certain price at a certain date. And even if the price of the stock goes below the strike price, and the strike price means what you're willing to sell it at, you are still selling it at a higher price. So, for example, if you are saying that you have XYZ stock, you are willing to sell XYZ stock in a year from now, and you are willing to sell XYZ stock for $100. At the time, the price of the stock is $90. Somebody will buy your shares for $100, even though the current rate is $90. This is why you are buying a put. You are paying somebody a premium to do this. When you are buying a call, you don't have shares. You are saying that you will buy shares in the future at a certain price. For example, you are saying you're going to buy XYZ shares. In a year from now, you are saying that you're willing to pay $100, but the share price goes to $150 at that specific time. You are still buying shares at $100, even though the share prices is $150. You understand? And for this, you are paying somebody the opportunity to buy shares at a certain price, even if the actual share price is higher at that specific date. That is the benefits of buying a put and buying a call. That's why buying a call, you are saying you're going to buy shares at a different time. You are bullish because you're assuming the shares, the price of the shares that you're buying is going to go higher than the strike price or the price you're saying you will buy shares at. And that's why buying a put is bearish, because you are saying you will sell shares of a stock at a strike price higher than the actual share price at that specific time. When you are selling a put or selling a call, it's the opposite. So buying a put, you're selling your shares. But if you are selling a put, you are not selling your shares. You are actually saying you will buy shares. And if you are selling a call, you are not saying you will buy shares. You are saying you will sell your shares. So the correct terminology is buying a put, buying a call, selling a cash secured put, and selling a covered call. Why is it called selling a cash secured put? Because you are saying that you will buy shares at a certain price if that price hits, no matter if the actual share price is lower than the strike price that you're saying you will buy at. For this, you are collecting a premium. You are the bank. You are making money, not spending money. The opposite holds true when you are selling a call, and that is called a covered call because you are covering somebody's call. In order to do this, you need to own 100 shares of the stock. Every option is always going to be 100 shares. Whether you're buying, selling a call or a put, it's always one option is 100 shares. Depending on what you're trying to do, these are fantastic strategies to maximize your earning potential when it comes to the stock market. Although I buy puts and I buy calls, I love selling covered calls and selling cash secured puts. When you sell cash secured puts and sell covered calls in unison, in conjunction, one after the other, this is something called a wheel strategy, which is something that I'm doing like crazy and something that I spoke about on this channel in depth. This is something that I'm going to be speaking about in the future, but I really just wanted to give everybody an understanding of what options are. Once you understand what options are, you can come up with a formula and you can come up with a thesis of what's good for you. When you buy a put and you buy a call, it is an option to execute, not an obligation. So you don't actually have to sell your shares if you have a put, and you don't have to actually buy the shares if you have a call. Maybe you want to sell the option. So you can also flip options, sometimes for a loss, sometimes for a gain. You don't have to execute the option. You can sell the option to the next person. When you are selling a put and when you are selling a call, you must buy shares if you're doing a cash secured put, and you must sell your shares if you're doing a covered call at expiration. However, if the expiration did not hit yet, there is a method called rolling out of those contracts, which means you are pushing the contracts to a different date or a different strike price, which I'll explain in just a moment. When talking about options, there's a couple of things that mean more than everything else. Number one is premiums. The premium is what you pay to buy an option, and the premium is what you collect to sell an option. For every option that somebody buys, every call, every put, somebody has to sell the call and the put. And this is called a marketplace. One is buying, one is selling. You're selling, you're buying, you're buying, you're selling. You understand where I'm going here? There's something called a strike. A strike is just the actual amount that you're willing to sell at or you're willing to buy at. That's the share price that you're willing to buy and sell at. This is not the share price of the stock at the time when you actually buy or sell the contract. This is the share price at expiration of the contract that you just sold or bought. Then there's something called an expiration date. An expiration date is when your contract finishes. The expiration date is the last day at the closing bell that your contract will get assigned or expire worthless. If it gets assigned, that means that you actually have to sell your shares if it's a covered call. If it gets assigned and you have a cash secured put, you must buy the shares. If you buy a put or you buy a call, it's up to you to assign that contract. You don't have to do it. Now, there's one more main terminology that I want you guys to know about. Actually, two. A lot of people, when they talk about options, you hear these terminologies of Greeks. So there's a couple of different terminologies of the Greeks. The Greeks is delta, gamma, theta, vega, rho. And then there's something called implied volatility. All you need to know for now is delta. And delta is the correlation of how much your options premium is worth in relation to $1 movement of your share price. For example, if you have a delta of 0.5, that means that for every dollar that the share price goes up or down, the premium that you are paying or collecting goes up or down by 0.5. The contract's worth, once you have a contract, is dictated by intrinsic and extrinsic value. Extrinsic value is time value, and intrinsic value is the value of your option in relation to the share price. And intrinsic and extrinsic value together gets you a premium. And the premium at the end of the day is what matters in an option. That's what gives the option its worth. Premium goes up, premium goes down. Depending if you have a put or a call, a buy or a sell, you want the premium to go up or down. It's different in each case for your or not for your favor. So the main Greek, the Greek that everybody knows, is delta. In the future, if you guys want to know, I'll explain what all of these Greeks are in detail, but most of you will probably never take the time to learn this. And that's not a knock on anybody. Most people just don't give a flying fuck about it. They just want to, wheel and deal. Finally, you have something called implied volatility. Implied volatility is quite simple. The implied volatility of your option is the implied volatility of the percentage of what it was for the trailing 12 months. So if you have an implied volatility of 120, that means that your option is more volatile than it was over the last 12 months. But if you have an implied volatility of, let's say, 50, that means that it is right exactly where it was over the last 12 months. If you have an implied volatility of, let's say, 20, that means that it's less volatile than normal. And all this means is the higher the volatility, the crazier the premiums are between paying or collecting. And the less volatility you have, the smaller the premiums you're paying and collecting. So if you're doing an option during earnings, or like the week of earnings, the premiums are going to be out of this world. But if you're doing an option, there's no FOMC meeting, there's no CPI, there's no earnings, there's nothing crazy. Your premiums that you're paying and the premiums that you're collecting are going to be smaller. Now, if you have an option and the option that you have is a sell a cash secured put or a sell a covered call, a lot of people are worried that at the expiration, they have to sell their shares. Let's talk about covered calls. So let's say you have a $19 strike for this Friday for PALANTIR. And that $19 strike, PALANTIR right now is trading at $20. So that means that on this Friday, you would have to sell your shares at $19, even though the share price of PALANTIR is $20 a share. There's a strategy that we call rolling. You can roll your option. And what that means is you either say that you are going to sell it at a different date or you're going to sell it at a higher or lower price. So there's a lot of ways to play the option game. So a lot of people are always worried, Adam, I don't want to do this. I might lose my shares. Listen, I'm not talking anybody into it. I'm just saying, if you know how to do this and you're playing carefully, then the probability is on your side, especially if you are selling covered calls and selling cash secured puts. Once you go to a higher strategy, like a higher level strategy and understanding, you can start playing implied volatility and really double and triple dip for the same exact options contract or chain. But that's something a little bit more advanced. Let me show you really, really fast a quick example, and I think that's going to be quits for this video. If anybody has questions, I'll be happy to answer it. All right, guys, very, very simple. Let's go to Palantir. If you're going to go to Palantir, you can press trade options. When you trade options, there's going to be an entire chain of options. And as you see, there's buy a call, there's buy a put, or there's sell a put or sell a call. It's very, very simple. In the middle, you're going to see this green ticker right here. It's always going to be the share price. On the left-hand side is always going to be your strike price. And it doesn't matter if you're selling a call or if you're buying a call, if you're selling a put, or if you are buying a put. It's always going to be the same. There's going to be a strike. There's going to be the share price. There's going to be the expiration of when you want your contract to expire. Most contracts are going to be weekly. You'll be able to do weekly, and then it, starts going further out. And then there's a premium. The premium is what you pay, and the premium is what you collect, depending if you are buying or selling your options. This premium is times 100 because every single option is 100 shares. Let me just show you a really quick example of rolling a contract because a lot of people have been asking me. These are my options right here. Let me use SoFi. This is a SoFi option where I am saying that I am willing to sell SoFi at $10 a share. Right now, SoFi is at $7.38. The current value of this contract is 10 cents. That's the premium. Remember what I told you. 10 cents for the contract. Now, this contract is 10 cents times 100 shares. So every single options is going to be $10 worth. I have 12 contracts, $10 worth, $120. Very, very simple. Over here, you're going to see that the contracts expire January 19th, 2024. So if on January 19th, 2024, at the closing bell, SoFi is $10.01 or more, I have to sell SoFi for $10. It does not matter if the price goes to $50, I have to sell at $10. However, there's a little button right here that says roll option. Now, a lot of people are always nervous and saying, Adam, I'm scared I'll have to sell my shares. And they're like, Adam, I don't want to sell my SoFi options for $10. And I'm going to say, okay, not a problem. So let's go back to January 19th. These are my options right here, okay? When you press roll, it's automatically going to roll you out. What does rolling out mean? At a different date. So let's say I want to roll this contract to February 16th. Let's say this contract is getting very, 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 very close. And I'm saying that I don't want at $10. I'm willing to sell for $11. Or you could roll this for the same price a week later, right? But let's just say the price is already $10 and you're saying, nope, I want to give myself an extra month. And now I'm willing to sell for $12, but I'm no longer willing to sell for $10. Just for an example. Well, let's click on this. You're willing to sell at a $12 strike. You're willing to collect 15-cent premium, okay? And your chance of profit is going to be 93.67%. Volatility is up there, but not through the roof, not catastrophic. So a lot of people are like, Adam, how do you actually do this? All you would have to do is click on this option And automatically, they are going to take the 10 cent that your current option is worth. They will then deduct it from the 15 cents of the option that you want to roll it to. They will then say you're going to get a net credit of 5 cents, and then they will give you a premium. The premium that you collect from selling cash secured puts or covered calls is instantaneous. That's yours to keep no matter what happens with the option. Guys, I hope this explains things for people. By the way, this SoFi example, it's not going to be as nice because we're not closer to the date. So once we're going to get closer to the date of January 19th, let's say it's going to be like January 10th or something, those premiums are going to change severely. I'm just showing you guys a quick example of how to do that. I hope this helped people. I hope people are taking advantage of this. I take advantage of this. Literally, I do this every single week. I do this on multiple different stocks. And this is a way of me doing a synthetic dividend. This is a way of me maximizing my returns. By selling covered calls and selling cash secured puts, which is my preferred strategy, every premium that I collect, I use that to buy something else, or I use that to just reduce my cost basis. So I'm essentially doing a fake dollar cost averaging down, if that makes sense. I do have options that I buy for calls, and I don't really buy puts. I do them once in a while, mostly for like S&P 500 or QQQ, but I'm not crazy about them. I don't like to bet against the market. It doesn't matter what I do. All that matters is what's good for you, your specific strategy and your specific techniques. I challenge you to open up your mind and think differently and go against the grain. Most people are not doing this. And I can show this technique to people 100 times and everyone's going to say, oh, Adam, I should do it. I should do it. And then they don't do it. This especially works really well if the price of something goes through the freaking roof and it had a crazy run up. If you sell a covered call on your shares and it had a crazy run up, or if you sell a cash secured put and the price of the stock went down like crazy, you're getting a really ridiculous premium because that volatility goes up. Guys, thank you so much. If you have questions, please ask. I'm doing my best to explain this. I might not be a good teacher, and I'm trying to talk calmly because I get really excited when I speak. Thank you, and have a great day.